somebody talked to us this morning for me to go to know whether we are able to connect, whether we are able to connect, whether we are able to connect. What are the main objectives of transfer pricing? Main objectives of transfer pricing.
He's saying goal congruence.
Goal congruence, I like that. Goal congruence, goal congruence. Performance appraisal. Yes, we are able to turn these particular departments here to profit centers and then be able to measure their performance on the basis of profits. Profits. So profit centers, performance appraisal, I like that. Number 3. Divisional autonomy. Divisional autonomy, ladies and gentlemen, that if, for example, A is transferring these goods here to a sister department at a higher price, B, sister department B, is at liberty to procure those goods from wherever they are getting them cheaply. So divisional autonomy, I like that.
Global tax minimization.
Global tax minimization, where these particular companies are able to shift their profits. They're able to shift their profits to tax havens. Those countries with very minimal taxes, if not zero. Thank you very much. And if I remember very well, we're doing this question that I sent to you through WhatsApp. I want to believe that you guys were able to download it and perhaps print. This one of Canorelli Enterprises. Canorelli Enterprises, I think will be better off if I could copy it here. If I could copy this question very fast, not a long one. I'm not copying that entire paragraph. I'm only copying things that I want. So they've given us the selling price here. They've given us the selling price. Selling price. So we have the selling price. The selling price could either be 100, we have 90, we have 80, we have 70, we have 60, we have 50. And then we have quantity sold. So we have here quantity sold, ladies and gentlemen. We have 1,000, we have 2,000, 2,000, we have 3,000, we have 4,000, we have 5,000, we have 6,000, we have 6,000, we have 6,000, 6,000. And then down here, they have given us, we can see, we have two divisions here. We have Guashati, and then we have Muga. Guashati and Muga, they have given us the variable costs. They have given us the variable cost. The person who sent to me this question never converted to a PDF. I don't know whether they have really changed, but according to this, that we have here, the variable cost of Guashati is 7. Variable cost per unit for Guashati is 7, and for Muga is 11. And then we have fixed costs. Fixed cost in this case here for Guashati we have 90,000. And then Muga we have 60,000. And then we have a transfer price. This is a separate note. We have here that Muga plans to charge a transfer price of shillings 35. To charge a transfer price of shillings 35. A transfer price of shillings what here? 35. A transfer price of shillings 35. And then we are required, ladies and gentlemen, required profit statements. Profit, that is A, profit statements for each division. And the company as a whole. So let us tackle part A first. We tackle part A first. Thank you very much. So part A, they want us to give them profit statements. You know, ladies and gentlemen, this concept of transfer pricing is a common concept in your AMA exams. Actually, this is among the topics that if you happen to know this topic very well, and then you know a topic like variances analysis, then you've got the short-term planning, especially on this key area of short-term planning, the one of what are relevant decisions. You can never fail. You can never fail in advanced MA. Never, ever, ever. So this is something that I would really beg you to take time to understand it and understand it very well. So we have here the profit statements. We have our companies always start by the company that is making goods, intermediate goods, goods for transfer, goods for transfer. So we have intermediate goods here. Remember, we have got two companies. We have here Muga. Muga is the one that makes what we are calling an intermediate good, which it sells to a company called Washati. And we were told by this examiner up there, if you have that question with you, we were told up there that Kanore Limited has two divisions, Muga and Washati. Muga division manufactures an intermediate product. An intermediate product is a product that is only transferred between divisions. It does not get any way to external customers. So Muga is the one that transfers these goods here to Washati. The moment you lose out on this first very important principle, then you can easily get a zero. Always start by identifying the first company, the one that is producing the intermediate product is the one, ladies and gentlemen, that should come first in this column. So we have here Muga, we have Washati, and then we have the whole company now, the whole company. So those three, the whole company, those three. So two divisions, and of course, when you combine them, we shall be having the whole what? The whole company, the whole company. Now, my great students, here we happen to be having quite a slight difference. Yes. Which year? This is a question that you have to copy. Yeah? It's a question that you have to copy because it's a very old past paper question. You may not be having it. You may not be having it. You may not be having it. Now, if you look at this particular question, there are various quantities here that will have to be produced and then what here sold. Various quantities to be produced and sold. If you organize your table, like this is the general format that you normally use, but if you organize your table like this, at the end of the day, you will get lost. Why? Because here we happen to be having various what here? Various quantities. You will see in our past papers, this will always be the format we shall be following because in our past papers, in most cases, this examiner gives you like two quantities only. But now these are very many. It means that we need to calculate these profits here for each division one at a time. So we start with Muga. Muga, I want to get the profits of Muga. How do we get profits, ladies and gentlemen? To get profits, we normally take a revenue we generate minus what here? Minus cost. Revenue minus cost. So Muga is not going to sell or rather produce goods of its own without getting instructions from Washati. So the quantity that Washati will sell to the external customers is the same quantity that Muga will have to be forced to produce. So we are saying that these quantities you are seeing here, they are quantities of Washati, but at the same time, they have to be the same quantities which will be procured from Muga. So we have here Muga, profit statement Muga. So Muga's quantities will also be Washati's quantities. So we have here quantity sold. Quantity sold, what do we have here? We have 1,000, 2,000, we have 3,000, we have 4,000. We have 5,000. We have 6,000. Now, can a good student give me the selling price of Muga. Muga's selling price per unit. Muga has produced these goods. It wants to know its revenues. Are you able to see Muga's selling price? Muga's selling price. In the notes there, are we able to see Muga's selling price? What are they telling us there?
This is saying 35.
35. Because these selling prices that you are seeing here, ladies and gentlemen, we are told in that particular note before that table, that the expected units of the final product, which Guashati division estimates, it can sell at the various selling prices. So Guashati is selling at these selling prices you're seeing here do not belong to Guashati, don't belong to Muga. Muga's work is very simple. Muga's work is to produce and transfer everything to Guashati. So Muga produces and transfers everything to Guashati at what price? They have given us Muga's transfer price is 35. So meaning that to get revenue, I need to convert these quantities. At what price? At 35, regardless of the quantity produced, regardless. The transfer price is not in advance and always remains what here? Constant, and always remains constant. So could you kindly give us these revenues? So revenue is what we have, 1,035, that gives us 35,000. Ladies and gentlemen, remember that for us to get revenue is always price times what? Quantity. Revenue is price times quantity. So we have 2,000 times 35. 2,000 times 35, 2,000 times 35, that will give us what figure? 2,000 times 35, that is 70,000. That's quite easy, 70,000. The next one is 105, 105,000. The next one is 4,000, 4,000 times 35, which gives me 140,000, 140,000. So we have 5,000 times 35, which gives me 175,000. Then we have 6,000 times 35, which gives me 200 what here, 10,000 like that. Now, ladies and gentlemen, having gotten such beautiful revenues, the next thing will be for us to charge expenses here. We charge expenses. So we want to charge expenses. Expenses, I can see there are two types of expenses here. We have, ladies and gentlemen, we have variable cost. Let us first of all capture the variable cost. So we have the variable costs. Variable cost, I can see Muga's variable cost is 11. Muga's variable cost is 11. Muga's variable cost is 11 per unit. So what we need to do to get out of variable cost, we shall be taking the quantity produced times 11. Quantity produced times 11. So the variable cost of Muga, the first one here will be 1,000 times 11. That gives us 11,000. This will give us 22,000. 22,000. This will give us, ladies and gentlemen, 33. From there, we have 4,000 times 11, which gives us 44,000. 5,000 times 11, this gives us 55,000. 6,000 times 11, that gives us 66,000 like that. Now, ladies and gentlemen, straight away come and capture the fixed cost. Come and capture the fixed costs. Fixed costs will always remain the same regardless of the volumes we produce. Fixed costs will always remain the same. The fixed cost of Muga, remember we are doing a profit statement of Muga. Fixed cost of Muga is 60,000. So fixed cost of Muga is 60,000. 60,000. 60,000. We have 60,000. We have 60,000. We have 60,000. So could you kindly then come and give me the profit there in shillings thousands? Give me the profit here in shillings thousands. Give me the profit there in shillings thousands. Remember, profit is revenue minus all the costs. Profit is revenue minus all the costs. So we have 35,000 minus variable cost of 11 minus fixed cost of 60,000. So I expect you great students here to give me answers.
Negative 36.
Negative 36. Thank you very much, Jockey.
And negative 12.
The next one is negative 12.
And then
The third one, the third figure.
Edit is giving 2.
2. The third figure according to Edith is 2. The fourth profit.
Edit is saying again 60,000.
60.
Mm.
This one is supposed to be 60. Let's confirm. It will be 140,000, 140,000, 140,000 minus 44,000 minus 60,000 minus the fixed cost of 60,000. 36. I'm getting 36. I'm getting 36. The fourth profit. The fourth profit.
Okay, the third one is 12,000. Not
The third one is supposed to be 12.
12 negative.
Let us confirm negative. Let us negative. Okay, the first. Is the first correct? Negative 36.
That figure is 12 from a corrective by
Positive,
positive.
Positive. And then the fourth one.
Then there is the third, the 36.
The fourth one is 36. The fourth one is 36. I'm being told that the fourth one is 36. The fourth one is 36. Go to the next one. What?
That's one then 84.
According to Edith, the fourth one or the fifth one is 84. Is 84. Is 84. How about the very last one? The very last one.
Sheila is saying.
Sheila. Sheila.
Is saying the last one is the fifth.
The sixth one.
The fifth one, Sheila is giving 60, so they are different.
They're different. So we have here 175 minus 55 minus 60, giving us 60. The fifth figure. The fifth figure, what answer are we supposed to be getting the fifth figure?
It's like the insisting it is 60.
60. 60 is the correct answer. 60 is the correct answer here. 60 is the correct answer there.
And then the sixth one is 84.
84. Or the sixth one is the one that Sheila was giving us, 84 like that. Now, ladies and gentlemen, if you are the manager of Muga, which quantity will you take up here as the optimal quantity? Which quantity will you take as the optimal? Remember, optimal is the very best. In terms of profitability, optimal means profit maximization. Optimal means profit maximization. So the one that we maximize this is our maximum profit, and therefore the optimal quantity. The optimal quantity to be produced is 6,000 units. 6,000 units. The optimal quantity to be produced there will be 6,000 units. 6,000 units. 6,000 units. 6,000, eh?
Yes.
Thank you very much. Now, without wasting time, could you kindly write there profit statement for Washati? Profit statement for Washati. 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 What do we have there? Profit statement for Washati. So profit statement, Washati. Profit statement for Washati here. So profit statement for Washati, ladies and gentlemen, we have the quantities to be sold. Quantities to be sold are the same quantities. Remember, quantities cannot be different between divisions. Quantities are the same here because it is a pull effect. What our customers need is what Washati will give them. And of course, Washati will demand the same quantities here from Muga. So the quantities here are the same. 4,000, 5,000, we have 6,000. Which prices am I going to use this time around? Which prices am I going to use this time around? Remember now, Washati is the one who is in touch with external customers. So the external customers have already given us the prices. These are the prices, ladies and gentlemen, for the external customers. We have 100, we have 90, 80, we have 70, 60, we have 50 like that. So come and give us our revenues very first. Don't forget that for us to get revenue, we normally take price times OTR, price times quantity. To get revenue, we normally take price times quantity. Price times quantity. Boy. Okay, WhatsApp.
No.
Okay. Yeah, that's like me read.
Which question is the question again?
There is a question that I sent to you, Mary, on WhatsApp for transfer pricing. On WhatsApp, I can resend it again. You have the question? Oh, okay. It's called the Canarelli Enterprises. You have it, eh? Thank you very much. I'll just show it there. So price times quantity, so 100 times 1,000, this gives me 100,000. 100,000. Then we have 2,000 times 90. It's always good to rely on our calculators. We have 2,000. However easy it may look, I always like my calculator. So this gives me 180,000. And then we have 3,000 times 80. 3,000 times 80, this gives us 240,000. And then we have 4,000 times 70. 4,000 times 70 gives us 280,000. And then we have 5,000 times 60. 5,000 times 60, that gives us 300,000. And then we have 6,000 times 50, which gives us 300,000. 300,000. 300,000. Now, ladies and gentlemen, I would want somebody to come and give me the variable cost of Washati. And the moment you give me the variable cost of the first variable cost, the total variable cost, the moment you give me the total variable cost of the first scenario, we buy you breakfast in the morning. We buy you breakfast in the morning. Given technology and M-Pesa and the ETC, this breakfast can be bought very easily right away from here. It will be the first one to give us the correct answer of the first variable cost of this scenario, the first scenario's variable cost. We buy breakfast. And remember, the breakfast we buy is good breakfast, very good breakfast. Very good breakfast. That kind of breakfast that you not eat using your bare hands. You need cutlery. You need cutlery.
You're saying, okay, Caroline 7,000.
Caroline 7,000.
27.
Okay, those two are enough. Those two are enough. Those two are enough. Ladies and gentlemen, for Washati, I can see the variable cost is 7 here. But remember, when you are treating divisions independently, whenever you are treating divisions independently, transfer price is always relevant and it will be treated as a variable cost on the buying division. On the buying division. When you are dealing, ladies and gentlemen, when you are treating this, when you are doing profit statements, for these two entities, for the two entities, we have a transfer price here. If I'm doing an income statement for the first division here, which is A, Muga, the transfer price of 35 will be relevant. It will be taken in as a revenue because then they are transferring goods to the sister department and then automatically they'll be earning this. But how about the second division, which is division B? Division B will be viewing this transfer price as a variable cost, as a cost because they are paying. It's variable because it is normally given on a per unit basis. And that is why for variable cost of Washati, you ought to have added what here? 35. 7 plus 35. Which is 40 what here? Which is 42. 42. 42. So there is nobody who got it right. So the first one should be 1,000 times 42, which gives me 42 what here? 42,000. So what have we said? That if you're looking at these divisions in isolation independently, the transfer fees are paid to procure the goods becomes relevant on both divisions. For the division that is buying, for Washati which is buying the goods, the 35 becomes relevant and it has to be lumped together with its variable manufacturing cost. Variable manufacturing cost. So we have 42,000 there. What is there anybody who got for 2,000?
Actually, Cindy or Cindy have an 42.
So if it's 42 here, so 42 is for 1 unit. So 42 times 2,000, that will give us what here, somebody? 2,000 times 42. 2,000 times 42, that gives us 84,000. 84,000. We go to the next one, which is 3,000 times 42. 3,000 times 42, which gives us 100 what here? 26,000. Then we have 4,000 times 42, which gives us 168,000. 168,000. And then we have 5,000 times 42, which gives us 210,000. 210,000. And then we have 6,000 times 42. Times 42, which will give us 252,000. Now, ladies and gentlemen, having captured the variable cost, the next thing will be for me to capture the fixed cost. The fixed cost. So we have here FC Football Club. So FC Football Club, what do we have over there? Fixed cost. Fixed cost of Guashati. Fixed cost of Guashati. This is, of course, an open one and quite easy. Guashati's fixed cost is what here? Is 90,000. 90,000. Thank you very much. So we have 90,000 there. 90,000 there. Because fixed cost from the name, it doesn't matter how many units you produce, even if you produce 0, 90,000 will remain. So come and give me a column of profits. Come and give me a column of profits. Pi does not stand for 22/7. For us here, pi stands for, ladies and gentlemen, pi stands for profit. Pi stands for profit. Pi stands for profit. So please give me the profits very fast. Give me the profits very fast. Okay. So what figures do we have here in thousands? In thousands? In thousands? The first one will be negative 32.
Second is 6,000 positive.
6.
Third is 24.
24.
Positive. Then the fourth is 22.
22.
Positive. The fifth is 0.
0.
And the sixth one is negative 42.
Negative 42. Negative 42. I hope these answers are correct. I hope many of us are able to get those answers there. I hope these answers are correct, ladies and gentlemen. If they are correct, of course, they would want you to advise the manager of Guashati. Tell the manager of Guashati how many units should they produce, rather sell. They can only endeavor to produce a quantity which is a profit maximizer. So among the profit that you guys have given me, if you're right, or if I pick the figures correctly, among the profit that you guys have given me, 24 happens to be the highest. So I'll come and say max profit, and therefore, ladies and gentlemen, the quantity that corresponds to this is 3,000, which becomes our optimal quantity. So the optimal quantity is 3,000. The optimal quantity is 3,000 units. The optimal quantity is 3,000 units. The optimal quantity is 3,000 units. Very good. Now, if you allow me, I'll go to the whole company now. Remember, what you have done is to look for profits of individual divisions. Profits of individual divisions. Now I want to consolidate everything. So come and mention there, profit statement, whole company. Profit statement, whole company. Profit statement, whole company. Profit statement, whole company. This is what you guys call consolidation now. Consolidation. So we start with revenue. Revenue of the whole company. I would want a good student to give us the very first revenue amount. The very first revenue amount of the whole company if we're to follow the consolidation process. If we're to follow the consolidation process, what will be the first revenue? Do we take revenue? Do we take revenue of Muga plus revenue of Gwashati? Do we take revenue of Muga plus revenue of Gwashati to get the consolidated revenue?
Repeat
the statement. Very good. So I want somebody from the perspective of now the whole company, which happens to be owning the two divisions, Muga and Gwashati, right? Okay. 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 So now here we are. We want to look for the consolidated revenue. So ladies and gentlemen, we have here the quantity. We have quantity. Listen and listen to me very well. Listen and listen to me very well. The revenue which will be effective, the revenue which will be effective from the perspective of the whole company will be revenue coming to the company through Gwashati, through this second company here, this second division, I mean. This other revenue that Muga is claiming to be getting does not make sense from the perspective. Are they able to hear me really? Okay, I don't know whether you guys are able to hear me this time around. No. Have you? I'm always muted. Sound is breaking. Hello everyone. Hello everyone. Are we okay now, or we are still breaking up? Okay now. Okay. So let's continue. Let's continue then. So I would want them to start afresh for the whole company, ladies and gentlemen. I would want us to start afresh. So then what we do, come and write there the quantity sold. Quantity sold. And as I was trying to explain here, ladies and gentlemen, we have our two divisions. We have Muga, and then we have Gwashati here. We have Muga and Gwashati. So what will happen is that for Gwashati, whatever revenue they sell, that revenue is what is genuine to the company. is revenue which is coming from external customers. How about in this case here, revenue that Muga is generating? The revenue which Muga is generating is not useful from the perspective of the whole company, because Muga is generating this department internally, this revenue internally. So it's money simply being transferred from one division to another. And that is why, from the perspective of the whole company, ladies and gentlemen, will come and copy the revenues of who? The revenues of Washati. The one that is selling to the external, consumers. Therefore, Washati's revenue is here. So we have here quantity sold, we have 1,000, 2,000, we have 3,000, we have 4,000, we have 5,000, we have 6,000. So come and give us the prices. We know the prices. We have 100, 90, we have 80, we have 70, we have 60, and then lastly we have got 50 like that. So give us the revenues. So revenues, what we have there. Give us the revenues. Revenues here, the first one will be 100,000. The second one will be 180,000, 240,000. And then we have here 280,000. We have 300 here. We have 300 there. Very good. Now, ladies and gentlemen, after that, kindly come and give us the variable cost of the whole company. That is where I would really want to involve you. The variable cost of the whole company. Could you kindly give me the variable cost of the whole company? Variable cost of the whole company. It is 18 per unit for the whole company.
Yeah, 11 plus 7, 18.
11 plus 7, 18.
57, 53.
Faith is saying 53. Any other suggestion? Please, for transfer pricing, I have to engage you so much. We have to talk because I know the sensitivity of this subject. Dan is saying 42. How did you get 42? Dan, if you could show us the working, how do you get 42? Or you simply took 7 plus 35. 7 plus 35, 42. Okay, I'm waiting for suggestions. Please don't fear. Even if you don't know, you can decide even to say any figure like 100, because today you have to talk. Cindy 38. 88. How did she get 88? Let me try to imagine 88. She took 7 plus 11 plus 35. That cannot even be 88. Cynthia.
Dennis 53.
Dennis 53.
Mercy 53.
Mercy 53. Seems 53 is carrying the day.
Osman 18.
Osman 18.
Isaiah 42.
42.
18.
Ladies and gentlemen, the correct answer is supposed to be 18. The correct answer is supposed to be 18. Why? Because transfer price from the perspective of the whole company is always irrelevant. From the perspective of the whole company, transfer price is irrelevant. And that is why in financial reporting, whenever it comes to consolidated revenues, if there are any internal transfers, what do you normally do? You subtract. Any intra-sales is normally taken to be what you are fake during the consolidation process, and as such, it has to be eliminated. Ladies and gentlemen, when I'm looking at this thing from the perspective of family, just like, for example, if I happen to be selling shoes, ladies' shoes, and then my wife comes and buys those shoes from me, of course, I'll not take her money. From the perspective of the whole family, that will be transfer of money from who? Husband to the wife. I mean, it don't make sense. Those are internal arrangements. any revenue that can be good, that will be good, is revenue that my madam is able to get from external sources, but not from myself. These internal transfers here are irrelevant. So what have we said? The transfer price, when I'm looking at this thing in the context of the whole company group, the whole company, the transfer price should always be eliminated, such that our variable cost for the whole company, for the unit, which has gone through two divisions here, will be the variable cost it attracted at Washati and the variable cost that attracted at Muga. So 7 plus 11 gives us 18. When I try to bring in transfer price of 35, I remember very fast, from the perspective of the whole company, transfer price is always irrelevant. Transfer price is always irrelevant. I want to repeat this in another way. The transfer price is only relevant when I'm appraising Muga alone and when I'm appraising Washati alone. But if I'm putting the two together as a farm, where the two divisions now will be one and the same thing, all those internal transfers will never ever be taken up to be relevant.
I'm getting confused.
So what have we said? What we have said, ladies and gentlemen, is that any transfer price, when it comes to the whole company, transfer price is always what here? Irrelevant. Never ever put it in your analysis. So like never come and tell us here, given that we're looking at the whole company, don't tell us, ladies and gentlemen, that we take 7 and plus 11 plus what? This 35 is what here is irrelevant. Because it is basically an amount that you put in to assess the performance of individual what? Divisions. The performance of individual divisions. But now that you are looking at the whole company, any amount transferred in between here is what here is irrelevant. Is irrelevant. Is irrelevant. So in this case here, we work with what here? 18. Are we together? Can I proceed? Can we go on? Somebody, if you are at least able to catch up something, you should be able to allow us to move on. You tell us yes, 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 or no, 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 no.
Yes.
Yes, thank you very much. So 18, so 1,000 times 18 gives us what figure here? 18,000. 2,000 times 18 gives us 36,000. Then we have 3 times 18. I love my calculator. Don't want to disturb my head. So 3 times 18 is 50 what here? 54,000. 54,000. 4 times 18 is 72,000. 72,000. 5 times 18. 5 times 18 is 90,000. And then we have 6,000 times 18, giving us 108,000. From there, you go to the fixed cost of the farm. Fixed cost, ladies and gentlemen, what do we have over there? Fixed cost. Fixed cost of the whole company. Fixed cost of the whole company. What do we have there? Somebody, fixed cost of the whole company.
150,000.
Thank you very much. Fixed cost, there is nothing like really thinking, because fixed cost can never have any transfer price in it. This transfer price will only appear in revenue, and the fixed cost you simply go and lump up together the fixed cost of the individual components. So individual components, fixed cost, we have 90 and 60, which gives me 100 what here? I'm consolidating fixed cost directly, 150,000. And of course, 150,000 now will be applicable throughout. So then give us a column there for profits in shillings thousands. Profits in shillings what here? Thousands. So you're taking revenue minus all the costs, minus all the costs. And then you give us the answers. Revenue minus all the costs, and then you give us the answers. Maybe I'm so sure you came in a little bit late, and I can assure you with my subsequent question, you'll be able to pick up this thing. It is the easiest topic in advanced MA. Students just pay for nothing.
I think this is the first one.
The first one as
Negative 68.
negative 68. Negative 68. The second one?
That's negative 6,000.
Negative 6,000. My figures are in thousands, no problem.
The third one is negative 36.
Negative 36. Growing the
36.
Positive, eh?
Yeah, positive.
Positive 36.
Then there's 58 and 60.
58
and 60.
and 60.
In that order.
Mhm.
Then the last one is 42.
42. So please never forget that once you have this, you must go ahead and tell us the optimal quantity. So my good students, from your observation, which quantity here will be optimal? Which quantity here will be optimal? Esau Kenyanjui.
This will say 5,000 units.
Okay.
I did 5,000.
5,000, yes, because you can see 60 here, being the maximum profit, 60 corresponds to 5,000. So the optimal quantity is 5,000. The optimal quantity is 5,000. Is 5,000. Is 5,000. The optimal quantity is 5,000. Now, before I proceed with this question, I would want us, ladies and gentlemen, to look at another small example. Another small example, very small example, which I would want us to write down. I would want us to write this down. Mention there illustration, 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 illustration. Illustration, illustration. So illustration, illustration, quite a good example. Division A, illustration, division A. Division A produces goods, and it transfers them, and it transfers them, and transfers them to division B. To division B, which packs and sells them, which packs and sells them, which packs and sells them, which packs and sells them to outside customers, to outside customers, to outside customers, to outside customers. Full stop. Division A, division A, division A has costs of dollars. Let's use dollars to minimize the figures. Of dollars 10 per unit, dollars 10 per unit, dollars 10 per unit, dollars 10 per unit, and the division B. And division B has any cars, costs of dollars 4 per unit, dollars 4 per unit. Full stop. Division B sells, division B sells the goods, division B sells the goods, to external customers, sells the goods to external customers, at a price of dollars 20 per unit, that is. Assuming a transfer price, of dollars 12, assuming a transfer price of dollars 12 per unit, calculate the total profit per unit, made by the company overall, made by the company overall, and then B, B, the profit per unit, the profit per unit, the profit per unit, the profit per unit, made by each division, made by each division, made by each division, made by each division, made by each division. So I want to give you exactly 1 minute. You try part 1 out for us. So we have some good relationship here between division A and division B, right? A makes goods, transfers all of them to B, which packages them and sells them to external customers. So A does not have customers of its own. And then they have given us parameters there, metrics there, which I need to play around with to get the total profit per unit made by the company overall or whole company. Let's see how they will be able to get this right. Hope you're following them on WhatsApp to see whether there is any who has a challenge. Eh? Very, very important. There's one who was saying has not been admitted. Okay.
I have 42 participants, but I think payment is around 17. I don't know. Payment.
Okay, admit me. So is there any student who has been able, ladies and gentlemen, to give us profit here for the company as a whole for selling only 1 unit? Is there anybody who has been able to do that? $6. The whole company will make a profit of $6. Anyone else who is getting the $6? Langat is getting 16 for the whole company. For the whole company. Ladies and gentlemen, because there are few, or rather there is only one product being sold in between here, I would rather come and make my profit statements like this. So we have company A, we have division B, and then we have the whole company. We have the whole company like that. So I'm going to have 2 types of revenues. I'm going to have external revenue, and I'm going to have what we call internal revenue, also called the TP. So we have external revenue, we have internal revenue, also called the TP, and then we go to the costs. So we go to the costs. So costs will also be like 2 of them, two costs. We'll be having in this case here the internal costs, here, what we call the TP, and of course then we have the external costs like that. So we start right away with the external revenue. I've organized my table in a bad way. I know what to do. Because you have the question down there, I can delete this. I write it well. I can write this better. So we have two divisions, A, B, and then we have the whole company. So you just come and give us the pro forma. So we have here revenue, or rather external revenue, external revenue, external revenue, and then we have, ladies and gentlemen, we have here internal revenue, and then we go to costs, of which we have the internal cost, and the external costs, So we start, ladies and gentlemen, with the external revenue, So which division is selling these goods externally? We are told division A has costs of $10 per unit, and the B incurs costs of $4 per unit. Then division B sells the goods to external customers at what price? So the revenue per unit for B is 20, we are being told. Of course, A does not have any external customer. For A, ladies and gentlemen, A, we are simply producing this good, and transferring everything to B. At what price? The price we are told is to assume a transfer price of what here? Of 12. So the transfer price there is 12. So A does not have any external customers. Now comes the internal revenue. Internal revenue is the one that A is making. A is selling this goods here to B, and they're able to realize, they are able to earn a price of how much here? A price of 12. They never gave us quantities, otherwise we would have multiplied. So we have internal revenue per unit is 12. And you can see, ladies and gentlemen, that B does not have any internal sale. So B internal revenue is what here is 0. So straight away, the moment I have this internal revenue, I know that for B, it will be an internal what? Cost. Because A is earning the 12 from who? From B. So the 12 is a revenue for A, but it's an internal cost for B. So remember, this internal revenue, as I was trying to explain, is our TP. And then the internal cost is what here as well, the TP or TC, transfer cost. Normally what we do, we play with the primary diagonal like that. You'll be able to get used to this. Now from there, ladies and gentlemen, we have these costs that are external. Costs in this case that are external, costs, for example, that we incur to buy materials, we paid labor, we paid the landlords, etc. So if you look at these are the own costs. We are told that A incurs a cost of how much here? Of 10. And then we are told that B also, when it comes to packaging, they're able to incur their own costs of what here? Of 4. Of course, the internal cost A does not have anything there. This basically is like a matrix normally. This is like a matrix. Yeah. Now come here to the whole company's perspective. So whole company's perspective, anything external makes sense. Anything external, so for external, come and add the 0 plus 20 from the perspective of the whole company, that gives me 20. Then anything internal does not make sense from the eyes of the whole company. Anything internal, you simply put what somebody there? 0. Anything internal, you put 0. But external will have to add the 10 plus 4, gives you what here? 16 like that. That gives me 16 like that. Now, ladies and gentlemen, if that is agreeable, come and give us what here? Profits. Come and give us profits. So profits, what do we have here? Somebody for profits. So for profits, we have here, of course, revenues minus costs. So like now you will talk of 12 minus 10, which gives me 2. Here we'll talk of 20 minus 16. 20 minus 12 minus 4. So 20 minus 16, that will give us what figure here, somebody? That gives us 4, right? Sorry, this is supposed to be 10 plus 4, which is 14. Sorry for that. 10 plus 4 is 14. 10 plus 4 is 14. And then lastly, we have here 20 minus this cost of 14, which gives us what figure, somebody? 6. Which gives us 6. So you can see the whole company's profit is what here? is 6, which has been split to the two divisions, A getting 2 and B getting what here? 4. B getting 4. B getting 4. So what have we learned out of this illustration? That anything internal from the eyes of the whole perspective will always be done what? Will always be ignored. Will always be ignored. Will always be ignored. Let's get to our past papers, try to see whether whatever we have done today is applicable in our exam situation. Let's get to our past papers, and I would want us to start with straight away, November 2016, question number 5. November 2016, question number 5. November 2016, question number 5, Sang Limited. Sang Limited. We are told the Sang Limited has 2 divisions. Have you gotten the question? You have the question with yourselves there. They have it. So we are told the Sang Limited has 2 divisions, namely X and Y. Division X manufactures electrical components, which it sells to Division Y and the external customers. Division Y has designed a new product branded Year 2. So we have 2 divisions. We have X, Y, and we are told that this Y has come up with a product called Year 2. Division Y has designed a new product branded Year 2 and has requested Division X to supply electrical component which is required in the manufacture of the new product. Each unit of product Year 2 will require 1 electrical component. This component will no longer be sold by Division X to external customers. So X will only be making goods for Y. Division X has quoted a transfer price to Y of shillings 45 for each unit of the electrical component. It is the policy of Sang Limited to reward managers on their individual divisions' return on capital employed. The details of the monthly production for each division are as follows. We have Division X output. Electrical component will be produced in batches of 1,000 units. The maximum capacity is 6,000 components per month. And then X, variable cost is 15. Fixed cost is 50,000. These are incurred specifically to manufacture the electrical component. Division Y, the output, product Year 2 will be produced in batches of 1,000 units. The maximum customer demand is 6,000 units of product Year 2 per month. Variable cost is 9 per unit plus the cost of electrical component. Fixed cost is 75,000. These are incurred specifically to manufacture product Year 2. The relationship, we are told, between the monthly customer demand and the selling price of product Year 2 is as follows. So they have given us demand, just like the question that I've given you, and then we have the selling price per unit required based on a transfer price of shillings 45 per electrical component. Advise the management of Sang Limited on the monthly profit that would be earned as a result of selling product Year 2. B, determine the maximum monthly profit from the sale of product Year 2 for Sang Limited. Using the marginal cost of the electrical component as a transfer price, advise the management of Sang Limited on the monthly profit that will be earned as a result of selling product Year 2 by divisions X and Y and the company as a whole. D, using the above scenario, discuss the problem of setting a transfer price. Suggest a transfer pricing policy that would help Sang Limited to overcome the transfer pricing problems it faces. So I want to give you, ladies and gentlemen, 1 minute. You try part A, where they want us, based on a transfer price of 45 per electrical component, advise the management of Sang Limited on the monthly profit that will be earned as a result of selling product Year 2. Let's see. 218. Page 218. So I'm giving you 1 minute till you try it. So you see that kind of a question, ladies and gentlemen, there is no way we can do this kind of what here arrangement. Why? Because the quantities to be sold are very many as per the demands given there. As per the demands given there. So it means that we have to handle one scenario at a time. So now here they are talking of year two, product year two. So product year two, so profit statement, product year two. Remember it is X, Y, and the year two is the one that is being sold to external customers. So we have here the demand. The demand has been given here. We have 1,000, 2,000, 3,000, 4,000. We have 5,000. We have 6,000. Of course, they have given us the selling prices. They have given us the selling prices there per unit. We have 120. We have, ladies and gentlemen, 110. We have 100. We have 90. We have 80. And then we have 60 what here? 67. So I expect you to write for us the revenue there. Come and give us, ladies and gentlemen, the variable cost, give us the fixed cost, give us the profit. Give us the profit like that. I would have wanted to do it for you very fast, but because of the sensitivity of the question, I expect you to finish it. You do it. Give me a few parameters there. Do it. So, ladies and gentlemen, is there anybody who has been able to get some understanding of that question, really? Understanding of that question? So, of course, for year two limited, revenues, I don't have a problem with revenues. So revenues, what do we have here? Revenues, I'll come and give them revenues very fast. I will give them revenues very fast. So we have 120,000. 120,000. This one here will be 2 times 110, which gives us 220,000. From there we have 300,000. From there we have 4 times 90, which gives me 360,000. So we have 5 times 80, which gives us 400,000. We have 6,000 times 67, giving us 402,000. So now we shall go to the variable cost. And the variable cost is where really my interest is in. What variable cost were you guys able to charge here per unit? So I say variable cost at what amount? Somebody. Variable cost at what amount? At 24, eh? Kelvin? 9,
Then it's 56.
Then it's 56.
Osman 54.
Osman 54. Dennis, how are you able to get 56? How are you able to get 56? You took what plus what? 50? Done after 54. 54 done, you must have taken 45 plus 9. Still, Dennis, I'm on your neck. I would want to know how you got 56. So what we have, ladies and gentlemen, remember we have got two divisions there. We have division X and then we have division Y. So X produces and sells everything to Y at what price? At 45. And then Y itself is going to incur a variable cost of what here? Of 9. So because we are appraising the profitability of Y alone, when it comes to variable costing of Y, I look at my variable cost as Y of 9, and then remember very fast, they're looking at me as if I'm different from X. So whatever amount I paid to X has to be incorporated, has to be fused together with my own variable cost, such that the total variable cost here will be 54. The total variable cost there will be 54. Is there any question there? Because we are appraising year 2. It is year 2, the second division alone. When you are appraising an individual division, then transfer price you pay becomes always what? Relevant. The transfer price you pay, because we pay the price to us, it's a cost. And because it's a cost which is given on a per unit basis, it becomes a variable cost. 54. Any question on this? I want to have as many questions as possible on this area because I know the moment now we understand this, we'll have understood the entire transfer pricing.
Yes, how did you get 54?
54, we took the transfer price of 45 plus the variable cost of Y, which is 9. Variable cost of Y is 9. If you read the variable costing, these people have given us the cost down there. If you look at the Y there, you'll be able to see division Y. There is a variable cost of 9. And then there is a place in this requirement based on a transfer price of shillings, 45 per electrical component. So it will be 45 plus what here? 45 plus the 9. You can't bring the variable cost of X or 15 here because really, here we are talking of division year 2, Y alone. So it should be 54. Any other question before I proceed? Thank you very much. So 54 times 1,000 That gives me 54,000. That gives me 54,000. Very good, very good. Now, ladies and gentlemen, after that, I have 54. 54 times 2, which gives me 1 weight, times 3, which gives me 162. I can have my figures in thousands. Then I have here times 4, which gives me 216. Then I have here times 5, which gives me 270. Then I have times 6, which gives me 324. Now, the column of fixed cost, fortunately, is a free marks column for everyone. What is the firm's, or rather, division-wise fixed cost? Division-wise fixed cost. Division-wise fixed cost. What is the value of division-wise? Somebody. Fixed cost of Y. Are they able to answer that? Fixed cost of Y.
Okay, Moses is saying 75,000.
Moses is saying 75,000. Thank you very much, Moses. Any other suggestion?
1575.
75. Thank you very much. And of course, because my figures are in thousands, I'll have 75 up to the end. And then now give me my column of what here? Profit. Give me my column of profit. So profit, what are we doing? We are taking the revenue, like 120 here, minus 54, minus 75, which gives us -9. We go to the second one, 220, minus 108, minus 75, which gives me 37. 37, so we have 300, minus 162, minus 75, which at the end of the day gives me 63. From there, we have 316, minus 216, minus 75, which gives me 69. I could be wrong. Please try to give us the correct parameters. 400 minus 270, minus 75, which gives me 55. From there, we have 402, minus 324, minus 75, which gives me what here? Which gives me 3 like that. If these figures are correct, let the ball not stop there. Always come and give us, ladies and gentlemen, come and give us the optimal quantity. The optimal quantity. So what will the optimal quantity be? The optimal quantity. So the optimal quantity is this that corresponds to 69. Because this is our maximum profit. So the moment you have that, then this 4,000 units are the optimal. They are the best you should produce. But you see, this examiner was a bright examiner. He never wanted you just to get the profit over Y. He wanted you to use that transfer price of 45. You get the profit of Y alone, but at the end of the day, extend that profitability analysis to Sun Limited, the company itself. So it means that this means that Y will procure 4,000 units from X, right, like that. Y will procure 4,000 units from X. And if that is the case, come and do a very small profitability statement for X. Do a small profit statement here for X regarding these 4,000 units. So in this case here, profit statement for X. Given the 4,000, so you talk of revenue, which is price times quantity. I know the quantity is 4,000. So times what price, ladies and gentlemen? Times what price, ladies and gentlemen? I'm waiting to hear from you. Times 45, because this X is simply transferring goods to Y. It doesn't have any external prices, it doesn't have any external customers. So they are only drawing, ladies and gentlemen, money from Y, and Y is willing to give it at 45. So we have 4,000 at 45. So what is 4,000 times 45? 4,000 times 45 will give us what figure? My figures are in shillings thousands. Mary, 180. From there you come and the less cost, of which we shall start with the Vice Chancellor cost, VC. VC is variable cost. Variable cost is normally pegged on the units produced. So 4,000. Are you able to see, ladies and gentlemen, where they're giving us? Are you able to see, ladies and gentlemen, where they're giving us variable cost of X per unit? Variable cost for X per unit. How much per unit? So 4,000 times. Shayla is giving me 15. So 4,000 at 15. Boniface 15. Thank you very much, Boniface. So 4,000 times 15 gives us how much here, somebody? 4,000 times 15 gives us how much? 60. 60, thank you very much. And then, ladies and gentlemen, we have the fixed cost, we have the fixed cost of X. We have the fixed cost of X. The fixed cost of X, which has been given there. I hope you're able to see the comments there. Fixed cost of X. I don't want to read from my book. Fixed cost of X equals what here, somebody?
Okay, fine. Mercy is giving you 50.
50. 50. So in this case here, 50. Please deduct the 2 for you to give us the profit for this division. Deduct the 2 for you to give us the profit of this division. So 180 minus 110. 180 minus 110 gives us what figure? Somebody here gives us 70. Gives us 70. Gives us 70. And therefore, ladies and gentlemen, therefore, the profit here, and therefore, the profit of Sang Limited, the profit of Sang Limited, the profit of Sang Limited, will be equal to profit of X, profit of X plus profit of Y, which will be equal to 70 plus 69, which gives us 100 what year? 39. 139,000. You see, as a good student of transfer pricing, you don't have to get everything up to here. No. There are quite many marks which are available here for free. Very many marks which are available here for free, which you should be able to tap. And of course, in this case, you'll be able to do what? To excel. Be able to excel. Okay. So we go to part 2 of this question, unless there is a question there. Part 2 of this question was quite an easy one. Determine the maximum monthly profit from the sale of product year 2. From the sale of product year 2. Now for Sang Limited, quite confusing. Determine the maximum monthly profit from the sale of product year 2 for Sang Limited as a whole. I want to give you a minute. You try this question. We see whether you can, have some understanding on how to start tackling it. Somebody may think that B and A are the same. Actually, many students in this sitting here were telling the examiners that they refer to above. There's nothing like that. They're not the same. Because the first one was pegged on a transfer price. And because of the transfer price, we were able to look at division Y alone. But now here B, there is no transfer price. So in short, they want us to give them a profit statement for the company as a whole, because company as a whole will normally disregard any transfer price. Let me keep quiet. You attempt it.
The transfer price is irrelevant.
Yes.
Transfer price is irrelevant.
Transfer price, part B, transfer price now will be what? Irrelevant.
This thing is asking what if you use the column format for X. Can you get the same profits of 70,000?
Good questions here. You see, if you use the column for X, you can't get the same profit. Why? Because you know the profit you have gotten here for X is dictated upon by the number of units here which are wanted by Y, which are 4,000. Which are 4,000. So you don't want in this case here all those other quantities. You only want to evaluate the profit of X on the basis of 4,000 units which are wanted by Y. Most of those questions you're asking, they are good, but what I can assure you is that most of them will be answered as we get along. As you do more questions, you'll be able to appreciate. Like now you realize, like in the question that we did, for the company as a whole, if you remember for the whole company, there's a question we did where we had two divisions, A and B. The profit for this was 2, the profit for B was 4, and then the whole company was what here? 6. For the whole company, we're able to get 6 by column wise, and we're able to agree. So the moment you have profit of one division and you have profit of the other division, you can simply add them to get the profit of the whole company. Profit of the whole company. So these are the kind of questions that at the end of the day, I'm so sure you guys will be sorted out with experience. So let us tackle part B. Let's tackle part B. So part B, what do we have there for part B? So perhaps I could help you to carry out, just to give you the framework. So we'll have here for the whole company, of course, the whole company, the revenue of the whole company will be the revenue generated by year 2, generated by year 2, generated by year 2. So generated by year 2. So we have here, demand will be the same. We have 1,000, we have 2,000, we have 3,000, we have 4,000, we have 5,000, we have 6,000. We have the selling price, of course, remain the same. The selling price remains the same there. So we have, ladies and gentlemen, selling price is 120, 110. We have here 100. We have 90. We have 80. We have 7. So the revenues will be the same. The revenues will be the same. The only bone of contention between yourselves and me will be the variable cost to be used here. So profit statement for Sun Limited. For Sun Limited, this is what we call the WC. The WC whole company always disregards any transfer price that is being given. Any transfer price that is being given. Disregards any transfer price that is being given. So basically, variable cost will be variable cost of the first division plus variable cost of the second division. Who can give us the answers? What do we have here as the variable cost per unit? Maybe 24. Done 24. Because what they've done, they've taken the variable cost of X, which is 15, plus variable cost of Y, which is 9. So 9 plus 15 is 20 what? 24. 24. And then, ladies and gentlemen, we have the column for fixed cost. So fixed cost, what do we have over there, somebody? Fixed cost. You will take the fixed cost of X plus fixed cost of Y. 125. Thank you very much. Thank you very much. Now what I expect of you is to come and give me the profit there. Come and give us the profit there. Give us the profit there. Give us the profit there. Give us the profit. Give us the profit. Okay. 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 my interest here will be, you guys giving me the optimal quantity. Optimal quantity. Optimal quantity of 5,000 is correct. Optimal quantity of 5,000 is correct. How many of them are able to give us 5,000 so that Mwalimu doesn't do it here? How many of them are able to get 5,000 out of the 40 students we have there? Are they like 30 of them?
I'm trying to identify different figures. I'm not seeing it.
Nobody's a different one, right? There's no one who has a different figure. Is there anybody who wants Mwalimu to do this question here? Or all of us are comfortable? We're getting 5,000. 5,000. No, thank you very much. So, ladies and gentlemen, look at part C. Look at part C of this question. Part C of this question. Part C of this question. Using the marginal cost of electrical component as a transfer price, advise management of SANG Limited on the monthly profit that will be earned as a result of selling product A to by divisions X and Y and the company as a whole. What a simple question. Using the marginal cost of an electrical component as a transfer price. So please write for me a title there, transfer price methods. I have to take you through some background before I do this for you. Transfer price methods. Transfer price methods. Transfer price methods. There are many of them. Transfer price methods. Transfer price methods. Transfer price methods. So transfer price methods. Transfer price methods. For example, in this case here, number one, you could decide to transfer all your products that you produce to your sister departments at marginal cost. So the first method there is marginal cost. Marginal cost, transfer price. Marginal cost, transfer price. This is where goods, intermediate goods are transferred, where intermediate goods are transferred to other divisions, at their variable cost, at their variable cost of production, at their variable cost of production. At their variable cost of what? Remember, variable cost is the same as what your marginal cost. So what we will do as the department that is producing these goods, we simply pile our costs. We pile our costs. As we pile our costs like that, ladies and gentlemen, variable cost only, we shall be able to say this pen has cost us a variable cost of what, for example, 10. So we charge exactly 10. We charge exactly 10. So in this question that you are doing, the one of X and Y, the one of U to limited, if we decide to charge a marginal cost as our transfer price, how much are we going to charge? How much will X charge Y for the goods? So transfer price, where transfer price equals marginal cost. If X was to charge a price that is equivalent to its marginal cost of production, what do you think in this case, ladies and gentlemen, will be the transfer price? Somebody talk to us. What do you think in this case here will be the transfer price? Sorry for that. So what you need to do is to ask ourselves, what is the variable cost of producing a unit at X? Are you able to see the variable cost there is 15? Transfer price of 15, thank you very much. transfer price of 15. So in that case here, then we shall transfer these goods at 15. Thank you very much. Now we go to the second method, which is called cost plus. Cost plus. So for cost plus, of course, now you'll be taking both what your variable. You'll be taking variable plus fixed plus profit plus fixed plus what here plus profit. So the plus here means profit added. The plus means profit added. The plus means profit added, profit added, profit added, profit added. And I would want us to write some short question on this cost plus before we proceed. We have to understand this basis. This basis. So mention the illustration. Illustration. We are told here that division A has a cost of $15 PU per unit, and it transfers goods to B, which incurs $5 to package the items. Division B sells externally. Division B sells externally at $30 per unit. The company has a policy of setting. Yeah, we are writing some illustration which you are writing, yeah? Who is asking? Okay, yeah. It's a different question because I have to show you the concept of how these goods are being transferred before you finish. Yeah, that's how you'll be able to follow very well. So we are told here that the company has a policy of setting transfer prices at cost plus 20%. At cost plus 20%. So we are required to calculate the transfer price. We calculate the transfer price, and then we have B, the profit made by A, B, and the whole company. Profit made by A, B, and the whole company. Profit made by A, B, and whole company. Profit made by A, B, and the whole company. Yes. We read the question again. So illustration, division A has a cost of $15 per unit. Please write that. Division A has a cost of $15 per unit and transfers goods to B, which incurs $5 to package them. Which incurs $5 to package the items. Division B sells externally at $30 per unit. And then we are told here that the company has a policy of setting transfer prices at cost plus 20%. So calculate A, the transfer price, and the B, the profit made by A, B, and the whole company, like that. So very fast, could you kindly give me the transfer price? Give me the transfer price. Give me the transfer price. Kindly give me the transfer price very fast. The transfer price, is there somebody who has been able to get the transfer price for us?
This team 18.
18, eh?
120.
120.
Osman 24.
Osman 24, thank you very much for your suggestions. Thank you very much for your suggestions. Please keep them coming. Keep them coming, keep them coming, keep them coming.
Dan 24.
Dan 24. Calvin 18. Langat 18. Justin 20. They're coming up with very good answers. Very good class here. Are they still giving us answers or now they are?
Okay, the next one is Dennis 18.
Dennis 18?
Isaiah 18.
18?
Philip 17.
Aha, great. All these students who are confusing, they have not drawn, they have not taken their time, ladies and gentlemen, to draw, have a schematic presentation of our process here. So we have a division A, and then we have division what here B. So we are told division A has a cost. The total cost here is what? Is 15. And then for B, we are told B, they will receive these goods at some transfer price, and the transfer price, we are told, is cost plus. Where very many students confuse, which cost should we use as the base? It is the cost of that company or that division which manufactures. The cost of the manufacturing company. The cost of the manufacturing company. And the manufacturing division, ladies and gentlemen, is division A. So you take the cost here, which is 15. So the cost here, the cost equals what here? 15. Plus, we have here 20% of our cost. 20% of our cost, which is what here? 15. So 20% of 15 gives us what here? 3. And therefore the transfer price is what here? Is 18. And therefore the transfer price is 18. So please don't confuse. It's about the cost of the transferring division. It's about the cost of A, the cost of the first department. You take that and add. Yes. You take that and add their profit, their profit, their profit. But you see, if you look at your past papers, normally you will have bad examiners. You'll have bad examiners. Examiners whose thoughts are hell-bent. They want to take you to hell in terms of exams, of course, in terms of your outcomes. What they will do, they'll tell you this cost plus. And then they'll tell you the cost of A. The cost of A is 30. And then they will come and they give you the profit margin. The profit margin of A is 10%. The profit margin of A is 10%. And then they require calculate the transfer price. Calculate the transfer price. Calculate the transfer price. Calculate the transfer price.
He's asking, what about 5 for package?
The packaging, thank you very much. Who is carrying the packaging cost of 5? Who is carrying that packaging cost? Is it A? No. A is producing at 15, and then they transfer everything to B. B now that will package. B will be the one packaging. So the packaging cost there is being incurred by B, not A. Not A. A is total cost of A has been given as 15. As 15. Thank you very much for that question. I hope I've been able to answer it. Okay, so come back here. They have given us cost of A very nicely. Then we have profit margin of A, 10%. And then they want us to calculate the transfer price using cost plus. Using cost plus. Using cost plus, using cost plus, using cost plus. What do we have there using cost plus? Ladies and gentlemen, remember margin has never married cost. They don't rhyme. So anytime they give you cost and you want to get the profit, you need to calculate profit markup. How do we change margin to markup? Listen and listen to me very well. If you are given a markup of 10%, for example, if you're given, for example, that is already with this. If I'm given markup of 10%, then to get margin is very easy. To get margin, I know that the margin's base is always bigger. Margin's base is always bigger. Margin's base is always bigger. So what I will do, I will come and talk over. You see the profit markup is 10 over 100. So what I'll do is to come and talk of margin, which will be 10 over 100 plus the profit here. Take this profit down. So then this will be 10 out of 100 what? Out of 110. That will be your margin. So what am I trying to talk about here? What we're saying is that margin has always a bigger denominator. Margin has always a bigger denominator. So if somebody tells you that the markup is 20 over 100, what will be the margin? 20 over 100, what will be the margin? 20 over 100, what will be the margin? Somebody look at the comment there. The margin will be? Yeah, thank you very much. It will be 20 out of 100, what here? 20, which is the same as 1 over 6. But now you see this examiner has given us margin. And this time around, we want to work backwards to markup. So then what do you think will be the markup value for us in this question? Markup has a smaller denominator. In markup, we subtract. Markup has got a smaller denominator. So the markup, profit markup will be equal to what over what? 1 over 9. What I will do is to talk of 10 over 100 minus 10, which will be the same as 10 over what here? 90, which will be the same as 1 over what here? 1 over 9. 1 over 9. Will be the same as 1 over 9. And now having gotten that, I'll now be able to apply my cost plus to get my transfer price. For this more illustration here, I will talk of cost plus equals TP. We start with the cost. So the cost here is 30. And then we talk of add profit markup. Add profit markup. The profit markup, you told me it is 10 over 90 or 1 over 9 times the 30. So 1 over 9 times the 30, what do we have? That's the same as 30 divided by 9. 30 divided by 9 gives us a beautiful figure of 3.333. So therefore, this department, ladies and gentlemen, will be able to get straight away a transfer price of 33.33 like that. Now, ladies and gentlemen, what do you think are the major disadvantages of this cost plus? Or rather, what is the major disadvantage of the cost plus? What is the major disadvantage of charging a cost plus transfer price? What is the major disadvantage? I mean, if I'm the manager of Division A, I will not have any incentive. I will not have any incentive of minimizing cost. Because assuming, ladies and gentlemen, just assume that they're charging me a flat profit of 10%. They're giving me a profit of 10% flat. So if I incur 30 shillings for every unit, I'll get a profit of what? A profit of 3. What if, as the manager of AI, work so hard and drive this cost down? I take this cost down, for example, 20, and the profit margin is constant, 10%. What will happen is that I'll get a profit of what, which is a reduced profit. So under cost plus method, ladies and gentlemen, the more inefficient you are, the more the profit. The higher your cost, the more the profit. So in this case here, there is incentivizing factor will always for you to keep on growing your core instead of reducing them. Thank you very much. My director tells me stop, and as such I do that. Good morning. If there are any questions, you can direct them in our WhatsApp groups. We'll be able to continue after this on WhatsApp. Otherwise, thank you very much. Have a great day. Thank you.